Welcome to Yahoo Finance Live. I'm Josh Lipton. That is Diane King Hall. Julie Hyman is off today. Let's get you caught up on everything you need to know here at 3 p.m. Eastern. Bad news is good news, at least for the stock market, that is. The October jobs report, that came in shy of expectations, and investors are taking that as a signal the Fed could be done raising rates. Stocks are rallying here, and markets are on track for their best week of the year. What it means for you and your money, that's ahead.
Plus, the conviction of Sam Bankman-Fried. The next phase of his case moves to sentencing, where he could face more than 100 years behind bars. We're looking at what's next for the crypto space now that that trial is over.
And Jeff Bezos heading to the beach. The Amazon founder saying, see ya later to Seattle, his home for decades. He's making a cross-country move to Miami. We're going to tell you all about it and why.
All right, we want to get you up to speed on today's market action. It is risk on Wall Street and in general for assets. You're looking at the Dow, better by more than 300 points there, a little off the highs of the session. The S&P 500 up 1.25%, better by 53. Nasdaq rallying triple digits, up 213 points. You're looking at the tech sector, the belle of the ball once again today. Yields, if we want to take a look at those, we've seen yields on the 10-year come down. At my last check, the 10-year was down about 10 basis points, down 11 basis points there. Yields on the 5-year, 30-year lower, as well as you continue to have this risk on move on Wall Street.
And your top story for markets today, that would be the October jobs report. The big picture here is that the labor market is showing signs of cooling. Job growth is healthy, but slowing down. Average weekly hours ticked down. The participation rate falling slightly, and the unemployment rate, that edged up to 3.9%. So this was a soft report, Diane King Hall. How soft was it? That's what you want to know.
Exactly. It was less than what we saw in the prior month. It came down by about half of what we saw in September. We had a note from Bank of America out today. They called this the Goldilocks establishment survey. So it's not too hot, not too cold. So that's why, again, you have this risk on move that you're seeing with regard to equities. I mean, the summer ended really hot. But in terms of October, we saw non-farm payrolls rise by 150,000, weaker than expected. Wall Street was looking for a print of about 180,000. So, again, it shows that maybe September, according to B of A, was more of an outlier instead of this inflection point that really had investors worried about the Fed's next move, right? Were we going to continue to see another hiking cycle, right? Sure, we just had a pause, but what happens in December?
Yep, I'll give you a few more headlines. Your economists point out that was your weakest headline in 4 months. The 2 prior months revised down by about 101,000. Unemployment rate ticks up, as we know, to 3.9%. As for wages, by the way, if you look at year-over-year trends, they are 4.1% from 4.3% in September. Bottom line, really weaker across the board. Now, what's interesting is Bank of America there saying they thought it was kind of Goldilocks. Let me give you a different take. MKM's Mike Darda, economist, he's a strategist, friend of Yahoo Finance. We love Darda. He says he sees things a little differently than the B of A crew, right? He says the economist is telling his clients that at 3.9%, the unemployment rate is 0.5 percentage points above its level 9 months ago. Right. He says that is a firm recession signal going all the way back to World War II.
It will be interesting to see kind of what plays out here as a result of this and what kind of pattern we see going forward, especially when we head into the holiday. Well, we're already really in the holidays, but what hiring looks like this month, through December, through the end of the year. One thing I want to pull out that B of A noted that I think was evident within this report, the manufacturing sector. You saw that fall by 35,000 jobs, right? B of A pointed out, of course, that clearly had to do with the UAW strikes that we saw, right? It affected employment in the auto industry, motor vehicles. We talked to some experts within that field, and they talked about the trickle-down effect, obviously, of the strikes, where you have smaller companies that are affected and they can't work as a result of that. strike. So, we saw declines in employment across a variety of sectors. Of course, we saw gains because overall it was a gain. Another thing that you and I talked about, I know offline earlier, is the ADP print that we saw earlier this week, which more closely aligned than we've seen in a while, because those two used to run kind of parallel. You used to look at one as a precursor to the other one, but there had been some divergence in recent years. This week, they came back together.
Yep.
All right, so the major indices are in the green today, reacting positively following the latest jobs data, which indicated some signs of slowing in October. Now, non-farm payrolls did increase by 150,000. That was a sharp pullback from September, which was nearly double that. Further cooling showed up in the unemployment rate, which rose to a nearly two-year high of 3.9%. Could be an indication that the Fed's era of high rates may be paying off. Here to discuss more is Philip Colmar, MRB Partners Global Strategist. Phil, thanks so much for joining us this afternoon. So let's get into what you took away from this report. What does this jobs report say to you about the state of the economy?
I mean, it was a softening across the board. So we did see that. That being said, I do follow into the camp that it's not that alarming. It's a moderation, nothing, more ominous than that or heading down. I mean, if we think about 150 jobs created in a normal cycle, that's pretty good, right? We're just getting accustomed to that. We've had some gangbuster months ahead of it. And obviously we're coming on the back of a strong month, more generally in September. But it's not bad when you put in those revisions, as you said, related to the strikes. It's actually quite a bit north of that. So it's not bad. The good thing about it is, though, is it's just one more case, I think, for investors anyway, and that's the way they're taking it. One more case for the Fed to go on hold. It's been looking to be on hold. It's had inflation kind of edging that way. I think inflation is going to bottom out well above where the Fed hopes it to bottom out. But nonetheless, it's structurally that way. You've got a softening in the employment conditions. This is a case for going on hold. And more importantly, a case for the bond market to stop rising, or yields to stop rising.
And Philip, just so you're in the camp that says the Fed is going to be on hold here. A lot of investors think that way. When do you think, Philip, the Fed could actually start thinking about cutting?
See, that's where we differ. We've been more of the fact that the Fed would be on hold longer. We leaned against recession scares earlier this year. We thought the Fed would go on hold, but the cuts were really going to get priced out of the curve. We looked for that breakout in bond yields. Of course, when we got to 5%, we said, look, this is when you think about monetary conditions getting restrictive, the subsidization, the easy policy that we had was in many ways the premature inversion of the yield curve. So we saw that kind of unwind materially in recent months, and the bond market, rather than the Fed, became the threat to the equities. We've seen an unwinding of that in the last week or so in an abrupt way, which is good for equities and is providing some cushion. It also puts us into the camp that we're not restrictive monetary conditions here. I think the Fed has a case to go on hold and wait and see, especially after the bond market remove. I don't see it having a case to cut because the economy isn't showing any evidence of heading towards recession at this point.
And I want to ask you, Philip, since you heard some of our commentary before, we were talking about a note from Bank of America where they called this report the Goldilocks scenario. Does it create a kind of Goldilocks setup for the Fed?
I think, look, the Fed has been looking for an excuse to go on hold, and inflation provided part of that story. The job market was the uncertainty associated with it and keeping the anxieties associated with the market on it. We get a bit of a softening in the job market. It's that excuse to go into that wait and see mode. Inflation's still higher. I think as we go into next year, inflation will bottom out way north of the Fed's target. That might put the Fed back into question mark again, especially if the economy is doing well. Clearly, the equity market's not signaling a recession or worried about one at this point. It is sort of that Goldilocks. But I think the bigger Goldilocks is that the bond market became the threat in many ways like it did in 2022. Yields were ratcheting higher. Equities were having difficulty under it. We're seeing massive multiple compression. Of course, yields became, stretched. Our bond yields became stretched to the upside. People were heavily net short. And I think what we've seen here is we've seen some short covering by the hedge funds. We were short. We recommended our clients to cover. And you've seen some of the long only kind of just step back in at the 5% and take a bite at it again. And so what it did is it arrested the biggest threat to the equity market. It brought down yields, and you're seeing that play out in equities right now. You're seeing that bounce.
And Phil, talk more about the equity market. Are you in the year-end rally camp?
We're in the, we've been calling for, funny enough, I hate to use the word Goldilocks because I'm a big fan, but she doesn't stay around too long. But we had been calling for sort of that window where we get a consolidation in bond yields, we'd get an upside in equities. That being said, I don't know how much of a drop in bond yields you get. I think it's more of a higher for longer interest rate environment, and bond yields maybe churn and kind of go sideways. And so I do think that there's an equity rally, but I do think it's a broadening of the equity rally beyond the sort of that Magnificent Seven at this point. I think investors should, for just out of prudence, whether you're more negative on the economy than we are or interest rates still being elevated, I think that they need to find places with better valuation support, better earnings support. And the tech sector has neither of those going for it. It's got a high earnings bar, stretch valuation. So it's enjoying today when bond yields came down. I still think you're going to get a rotation out into, say, financials, say aerospace and defense, some healthcare exposure, some of the other, maybe a bit of energy services. So some of the broader other names, a broader participation will be more likely.
So, Philip, you said the bond market has become the greatest threat when we think about financial assets. Have we already seen peak yields? And what do you mean? Like, what threat is there that remains in terms of the activity there?
What I mean is investors often get too fixated when they think about monetary tightening and fixate on the Fed, right? And the Fed does influence short-term interest rates. But as we know, when you're dealing with an economy, and particularly this economy, there's a lot of private sector borrowing that doesn't happen at short-term floating. It's further out the curve. So earlier this year, we had a premature inversion of that yield curve, and we were subsidizing all the borrowing that was longer dated. So when yields rise, they can do a greater job in many ways of tightening monetary conditions than the Fed. And so the Fed may have already been transitioning to hold, but yields were ratcheting higher. And that came into the limelight, or in the center stage, as the threat. So it was important for it to peak. I think our theme has been is that bond yields would go up in waves and adjust in waves. We've seen the last wave, and we look for another consolidation here. That being said, I don't think this is the breaking point. I don't think cost of capital has yet brought us into recessionary territory. And I do think inflation will bottom out higher than people think, but that's a 2024 story. And so I think there's a case after this consolidation that yields take one more punch higher before we do enough damage to the economy. So I don't necessarily think we're at a cyclical peak, but I think we're at a peak for a while here, which gives you sort of that Goldilocks window of the next few months, per se, if you want to use that term.
Philip Komar, thank you so much for joining us today, Philip. Appreciate that time and insight.
Sure, thank you.
Moving on, let's get to some movers. Apple shares edging lower in today's trade, but off the worst levels of the day now, following last night's earnings that showed weakness in China and the company given a sluggish sales outlook for the holiday season. So this one, Diane, Apple reported sales falling for the fourth consecutive quarter, right? They did, though, beat expectations. iPhone performed better than it projected.
Right.
Higher margin services business, that beat estimates. Strong gross margins, 45.2%. And we did speak with Apple CFO Luca Maestri. He told Yahoo Finance about the new iPhone 15 models. Luca Maestri telling us the initial signals, in his words, he said, are positive. He also knows there's supply constraint, by the way, on those high-end 15 Pro and 15 Pro Max. But the attention is, of course, on that outlook and the forecast for that all-important December holiday quarter.
Yeah, and I've been looking into some notes for some analysis on Apple. So Oppenheimer out with a note. Oppenheimer saying that the fear of losing iPhone share in China is overblown. Oppenheimer reiterating an outperform rating on shares of Apple. I mean, it says they expect the concerns about Apple with regard to its China share loss to dissipate heading into fiscal year 2024. Oppenheimer saying Apple delivered solid results. I mean, we saw the numbers. The guidance was against a tough macro backdrop. Oppenheimer favoring that it's long-term growth potential for Apple. So, it's definitely reiterating its stance on the company. One of the things that I know that you probably noticed with regard to Apple, and there's been talk about this, where is it with regard to generative AI? We know that Tim Cook talked about that. They've been working on generative AI, and obviously they have work going on, and they're investing in it. We're just waiting to see what is it going to be its answer to, say, ChatGPT, right? Right. Because we know that Microsoft has the advantage there, at least from what we know that's out there. But if we know Apple, You know it better than anybody else besides Tim Cook, that they're not going to put something out there before they're sure.
Yeah, Apple does not tip its hand to its portfolio like a lot of other tech companies do. I do on that guide right now. What analysts know is the implied guide was 117 billion versus expectations about 123. Of course, we don't get that report now until probably late January, early February. So we got some space here to think things over.
Right. All right. Another stock that we want to look at is Block. Shares are soaring today after the fintech company beat estimates, raised its full-year EBITDA guidance, and announced a $1 billion share buyback. You have a number of companies out on talking about its performance. You have B of A out with a note on Block. I mean, that's the company behind Square, behind it's Jack Dorsey's company. Behind Cash App, solid revenue from Square and Cash App. This is what B of A is saying. They called it just what the doctor ordered. They're reiterating a buy rating on Block forwards. They called out that EBITDA outlook. It's pointed out that it is more than 20% ahead of what the street expected, Josh.
Yeah, it is. Listen, that's a nice pop in today's trade, though. We should note it is still down hard for year to date. It's still down more than about 20% there. So, listen, Jack Dorsey, company raised its forecast for adjusted profit for the year. It sounds like they're now looking for between 166 and 168 billion. That was higher than analysts had been looking for. Capital return program you mentioned as well. It sounds like you can trace this back to the company's core businesses, right? So Cash App and Square, those two saw profits jump 27%. And it looks like 15% respectively. I thought also the interesting read on the consumer here from the CFO telling Bloomberg from a Cash App perspective, what we see is continued healthy trends in the consumer space. As we were just talking, though, about the labor market cooling, that's been a real tailwind for the consumer. We'll see if that keeps up for Block and, of course, many other companies.
Yeah, and also another note. Just how they're managing costs. That's something that stood out in terms of, one of the notable things is their plans to cut costs, efficiencies, et cetera. So JMP pointing out that the headline number is a decision to reduce headcount from 13,000 to 12,000 by the end of 2024. So Dorsey saying there's going to be a cap on headcount until, quote, the growth of the business has meaningfully outpaced the growth of the company.
All right, moving on. Final ticker here. Cybersecurity company Fortinet sliding after it cut annual guidance a second time. It now sees 2023 revenue of $5.33 billion. That's down from a previous guidance of $5.45 billion. So this one, not good news from the company. You can see the reaction there. We're down about 13% in today's trade. Cut the guidance. Now sees fiscal 23 revenue, as you said, as much as $5.33 billion. Remember, this company also, what they do, they sell antivirus products, they sell firewalls. This is the second consecutive quarter, though, where they cut guidance. And by the way, though, it's a tough time for this company. Worth pointing out, different story at Cloudflare, which is another cybersecurity name. They reported beat, raised guidance, and that stock's moving higher in today's trade.
Yeah, exactly. You have convergence happening there. I noticed that with Cloudflare. And originally, Fortinet had put some pressure on that sector. TD Cowen out with a note about Fortinet, saying that this is going to be a year of transition for this company, pointing out, obviously, the miss. This was on lackluster demand for its products, billings, et cetera. The outlook, it needs to turn around. You had Guggenheim also out with a note on Fortinet, saying that, this is due to the cyclical downturn that we're seeing. It just led to another poor quarter, to your point. Guggenheim pointing out that, and this is led by Raymond McDonald, that it's going to get worse before it's better for this company, clearly, and is getting punished in terms of the action today. And when you think about the kind of day it is, it's a risk-on day that we're seeing on Wall Street. There's no grace being shown to this stock at all right now in terms of its performance.
No mercy into the weekend.
No.
We are just getting started here on Yahoo Finance Live. Coming up, the verdict is in. The jury finds former crypto billionaire Sam Bankman-Fried guilty for his role in the collapse of cryptocurrency exchange FTX. We're going to break down how that trial will impact the crypto industry moving forward. That is next.
Sam Bankman-Fried found guilty of defrauding FTX customers, investors, and lenders in what is being considered the biggest case of its kind for a generation. After roughly 4 hours, the jury decided to convict him of all 7 charges. Our own Alexis Keenan was in the courtroom. Alexis, paint a picture for us. What was the reaction and what was it like?
Diane, this verdict was so swift, so stunning. Just the jury deliberating for about 4 hours. So this was very, very fast to come to this decision, finding Bankman-Fried guilty on all 7 charges charged by the Justice Department, those being wire fraud and conspiracy of wire fraud against FTX customers, wire fraud and conspiracy against Alameda Research, that's Bankman-Fried's sister hedge fund, crypto hedge fund, against that lenders to that entity, also securities fraud conspiracy, commodities fraud conspiracy, and also money laundering. Those charges, though, as they were read, Bankman-Fried's parents sitting just over his right shoulder in the courtroom with his father hanging his head well below the pews there in the courtroom, looking devastated, his mother tearing up as they heard this verdict read by the jury's 4-person, while just Bankman-Fried and the 4-person, the 4-woman, I should say, read these charges and showed the jury's verdict there, the 2 of them standing while everybody else was seated in court. Now, ultimately, though, the sentence, that's what comes next for Bankman-Fried in March at the end of the month. Ultimately, that's going to be decided by the judge who presided over his case. The sentence is strictly at the judge's discretion. He can impose a maximum sentence. In this case, when you add up all these charges, maximum prison time is 110 years. The judge has dozens of factors that he can weigh in making that decision. And one place to start, though, is the sentencing guidelines. There are federal sentencing guidelines that give him a clue of where he might want to begin making that calculation. Guys?
And Alexis, you mentioned some of the things that the judge here can consider in the Bankman-Fried sentence. Tell us more about how the money allegedly stolen comes into play.
Yeah, so that's going to be a major challenge for Bankman-Fried here because the way that the sentencing guidelines are designed, and they're not mandatory. These are recommendations, but it's definitely a place where judges begin. They take into account the amount of money that the victims of the scheme lost. And so those, though, I want to just show you on the screen. Take a look. The suggested offense levels and these enhancements for wire fraud, the recommendation enhancement begins at $6,500. So you think about this multi-billion-dollar enterprise with the government saying that Bankman-Fried took 10 to 14 billion from FTX customers. It goes all the way up and tops out at enhancements. If you look there at enterprises, schemes where victims lost more than $550 million, certainly he far exceeds these numbers across the board. Now, that takes Bankman-Fried from a wire fraud offense, for example, a base level 7 offense, all the way up to a level 37 offense. And that's the difference between 0 to 6 months recommended behind bars to 262 months behind bars. And if you do the math there, that's 22 years. Certainly for one of the largest frauds in U.S. history, this puts Bankman-Fried in a really challenging predicament. His sentencing is set for March 28th.
All right, great insight, Alexis Keenan. Thank you so much for doing all of the coverage on this generational case.
And as we close the chapter on Sam Bankman-Fried's case, and Washington now faces pressure not to allow anything like this to happen again, it leaves us asking, what does this mean for the broader crypto industry? To help answer that question is Sam Enzer, partner at Cahill Gordon Rydell Law, and podcaster and crypto commentator Scott Melker, host of Wolf of All Street. So, Sam, let me start with you. First, Sam, just your response, your reaction to the verdict.
First, thanks for having me on again. It's a pleasure to be back. I think that, to me, the verdict is not surprising, but it is a confirmation that this type of behavior, fraud, will not be tolerated, whether it's on the blockchain or on Wall Street, or anywhere else. Fraud will not be tolerated. I think the jury clearly was receptive to the government's case, was not persuaded by Bankman-Fried's testimony, And we saw that with their swift verdict. The government acted swiftly in this case, charging the case very quickly after the fraud was discovered, roughly a year ago. And the jury, met that challenge and quickly came back with what is clearly the right verdict. In terms of what it means for the market, that's a broader question.
Scott, what does this signal to you when it comes to kind of the conviction about, what does this conviction signal about conviction as it comes to crypto, right? Does this create more clouds, or does this clear up the clouds in your mind?
Potentially it clears up the clouds a bit, but I think it's important to note that this was a case of fraud that has literally nothing to do with crypto. Bernie Madoff didn't need crypto to commit fraud and the largest Ponzi scheme in history, and there's been frauds throughout history that haven't relied on the blockchain or crypto to do it. Sam Bankman-Fried would have found a way to do this, whether it was with crypto or not. And I think that most people have really come to understand that nuance over time. I think that this definitely puts a bookend on this, puts a close to some of the outright frauds and the contagion that we saw last year. There are still some other impending cases and potential cases that they could impact the market. But I think largely now crypto has moved on. And I think it's really important to remember that this was very much a United States focused thing. I go to conferences all around the world. I was just in Singapore a month ago, and nobody's talking about FTX. Nobody's talking about SBF. It was a blip in the news cycle. He's really an American celebrity, and this was an American phenomenon in a worldwide asset.
And Sam, let me get your take on that. Listen, this was a big case, big personality, made a lot of headlines. Now we have a verdict. Do you see broader implications for the crypto ecosystem, the crypto industry and market?
I do, and I think it'll be positive. So while I agree that fraud is fraud and that this fraud had nothing to do with crypto, I think that the government's investigation did have to do with crypto. The government had to use the blockchain, understand the technology, understand the way that assets were commingled, the relationships between customers and a crypto exchange. It was able to do that. It did it effectively. It prosecuted the case swiftly. It did justice. And what that means is we as market participants, should have confidence that there are cops on the street, that there is a cop on the beat that will make sure that there's market integrity, and that the bad actors will be taken care of, so that there is room for the good actors, the folks who are legitimate business people taking advantage of this transformative technology to build opportunities can do that. And investors and customers should feel confident that they will have the same safety when it comes to investments in digital assets and the regulation of that space as they would in any other asset. There are also lessons learned in terms of, yeah.
Well,
Please.
I just wanted to ask you really quickly, because obviously he's now facing potentially more than 100 years in prison. Does a sentence of that magnitude match the crime in your mind?
That's a very complicated question, because I think I was actually in the courtroom when Bernard Madoff was sentenced. I was a young federal law clerk at the time, and my judge had the Madoff civil case, and we were close with Judge Chin, who was handling the criminal case. And I think that there are some parallels between the Madoff case and the Bankman-Fried case, but there are also a lot of differences. Madoff was somebody who had been an unrepentant fraudster for decades, and he was facing justice late in his life. Bankman-Fried, as far as we know, this is a first-time sin for him. He is young. He's like 31 years old. And so I think it's a difficult question. What do you do to impose punishment on somebody who did something very, very bad, but might be redeemable? Perhaps in 20 or 30 years, this is a person who could make a contribution to society and isn't part of, in punishment, believing that we can rehabilitate people. So it's not as simple as some of the other cases we've seen, like Madoff.
And Scott, I want to bring you back in, talk a little bit about Bitcoin, where we are, where you think we're headed. We did see a rally there. I mean, obviously well off those record highs of 69,000, but obviously there's a lot of enthusiasm, Scott, as you want them on crypto fans for that spot Bitcoin ETF. You think, Scott, that you think the SEC approves those products? And if so, when do you think so? By the end of this year, early next? What do you think a timeline is?
Listen, I look to the experts and ask the exact same questions. I often talk to Eric Balchunas and James Seyfert at Bloomberg on my own shows. They're the ETF experts. They say 90% chance of approval by the end of the year or January 10th, which is the last chance that the SEC effectively has to reject the ARC filing that we've seen. We've seen real moves with BlackRock getting listed on the DTCC website. Galaxy getting listed there as well. That means that they're likely starting to seed those funds. I think that the SEC has to capitulate on this after they lost to Grayscale. And I really think that this could be a face-saving measure for Gary Gensler, who's been disgraced repeatedly, over and over again in court, just continues to lose to the judicial system. The SEC can now throw the bones to the crypto industry, say, here's your Bitcoin spot ETF, it's approved, and then he can go about his merry way accusing everything else of being a security, which seems to be his mandate coming down, obviously, from somewhere up high. I think that this thing absolutely gets approved. I think the price action that we've seen is largely on that assumption. This is one of those rare cases where you as an individual can front run what institutions are going to do because they're going to come in once they have the ETF in a way that they can, act on their fiduciary responsibility and responsibly buy this asset. So I really think this is a great opportunity for people. We will see an ETF approved, and it will be very, very beneficial for the market.
And Sam, I just want to end here with you on this question. From what I've read, Sam, Bankman-Fried is tentatively scheduled for a second trial on campaign finance early next year. Do you think that should go ahead, Sam? Would you press ahead with that, or do you think, listen, we've got a verdict now, let's move on?
I think enough is enough. No need to pile on. The government has made their point. As you heard Damian Williams, my friend, former colleague, and the U.S. attorney, say they've got enough handcuffs for all the fraudsters in crypto. So I don't see a need to proceed with that trial. I think it would not be an efficient use of judicial resources to make a bunch of witnesses show up and put them through another trial, nor do I think that the government has significant appellate risk such that they would want to get other charges and other convictions proven up so that they have a backup. They don't need it. So if I was the government, I would not proceed on those, and I would just move forward to sentencing.
Sam Ensner and Scott Melker, guys, thank you both for joining us today. We really appreciate it.
Thank you for having us.
Thanks.
And coming up, our big breakdown of the October jobs report. We'll discuss just how much strikes have cost the U.S. economy this year. That is next. The first trading week in November is off to a strong start here. The Dow is eyeing its best week since October of 2022, and the Nasdaq Composite and the S&P 500 are tracking for their best week since November of last year. Yahoo Finance's own Jared Blickery is on the floor of the New York Stock Exchange with more. Jared.
Hey, Josh, love those stats. In addition, I'd say small caps, Russell 2000, best week in years, and it's going to be a nail biter, but could be one of the best weeks since 2020. Now, I want to go to the Wi-Fi Interactive just to show some of the things that have been moving the market this week. Three big market movers in general, and that is the Fed, that's inflation, and that's also jobs. We got 2 out of 3 this week. This purple line in the background, by the way, this chart goes back to 2020. It captures the pandemic lows down here. The purple line is SPY, the S&P 500 ETF, and then in cyan, we have Federal Reserve decision days. And guess what? We just got that little uptick. They had been trending down, so a bit of a reversal of fortune, which bodes well for equities. Also, monthly unemployment situation days, that's NFP. We have 2 in a row where we had really nice pops off of that. And CPI, I believe we'll get that next week or the week after. That's been relatively flat lately, but things have been moving in the right direction. Now, we had a huge scare in rates in the month of October, and I think a lot of investors are wondering what is in store for the month of November. If we do get this continued reduction in rates, that does speak well for equities. Here I'm looking at the Dow, that's 5 days worth 5.16%. The Nasdaq is going to be having a little bit of a bigger return. Let's see if we can check in that there. Yeah, 6.7%. The Russell 2000 small caps, 8%, as I was talking about before. But want to check in on the 10-year. That is down to 4.56% after hitting 5.0% only a few weeks ago. This big drop in rates has really allowed volatility to come down. And here's this week in the MOVE index. That is down considerably, and so is the VIX. It went from 21 all the way down to 15. Let me just show you and close with a couple heat maps here, looking pretty good for the week. This is what happened today, nice and bullish, but for the week, look at that outperformance by the mega caps. NVIDIA up 11%, Amazon 8, Apple 4, Microsoft 7, list goes on. And just taking stock of the sector action, everything in the green. Energy, the laggard, but real estate, rare circumstance where real estate is the biggest outperformer. That is up 9%, biggest week in years there, guys.
Jared Blickery, thank you. Now, slowdown in the October jobs report.
That's right. Payrolls came in cooler than expected as unemployment ticked up. Now, this change of pace for the Fed comes to weigh after September's red-hot report blew past expectations. UAW members and actors on the picket lines both registered hits to the October's jobs report last month as strike activity continues to weigh on the U.S. economy. For more analysis on the latest jobs report, we're joined by Kate Duchesne, RGP CEO. Kate, thank you so much for joining us this afternoon. When we look at this report, it was cooler than expected when we think about kind of the number, the overall number, 150,000. There was still growth in the job market. So it seems that the job market is still holding up, relatively speaking. What does this point out to you when you think about the trends that we're seeing within the job market?
Right. Well, good afternoon, and thanks for having me today. I mean, these numbers do show that the labor market conditions are starting to stabilize. But we still see in certain sectors, we're a consulting company working in business services, that there are still skills gaps out there, and there are still gaps that companies are struggling to fill.
Kate, as I understand it, your firm really focuses on finance, healthcare, and tech sectors. So I'm interested just to drill down into those sectors. What are you seeing there in terms of hiring trends?
Yeah, what we're seeing again is that those sectors still have big transformation projects. We recently completed some external research, and on average, these clients in finance, healthcare, tech, manufacturing have on average 20 transformation projects. A lot of them focused on digitization efforts or technology transformation. And they still don't have enough of the right skills in their own environment to complete the work on their agendas. So what we're seeing is a phenomenon we call the dynamic workforce, where companies are relying on both their own full-time equivalent workers, but also turning to outside talent to fill the gap.
Kate, when you say transformation project, what does that mean exactly? Can you give some examples of that?
Sure. Digitization is one. You know, they're bringing in new tools to ensure that knowledge access happens in their organizations. Think about how people are working today. Lots of companies are still hybrid, for example, and so access to information has to happen in a more digital form than ever. Because people are distributed, perhaps in the United States, but also around the globe, and need access quickly and efficiently to the information they need to do their jobs. So we see digitization as a big effort. Finance transformation, as every company is trying to bring more automation, get data ready for AI initiatives, et cetera. So, you know, it's just continuing. We live in a very disrupted world with companies fighting competition every day. And so everybody's continuing to try both and improve their customer experience, but also the efficiency throughout their value chain.
So, Kate, there's a few things that stood out to me in what you just said, a few words. You talked about digitization. You talked about AI, of course, and disruption. So when we think about AI and jobs, there's been all this talk about, is it a jobs creator or a jobs destroyer? From your purview, what is your expectation for where the job market will go, especially as we finish out the balance of this year, when you think about the influence of AI and where companies are coming from?
Okay, so most companies are not ready for AI. And I say that because their processes aren't standardized and their data is not in a clean shape. It's either not governed correctly and it's not clean. And until you have standardized process and clean data, you can't really move to AI in a meaningful way. So I think AI may disrupt us down the road, but it's not going to disrupt the labor market materially today, because there's too much readiness work that has to happen in organizations.
And Kate, last question here on the subject of remote work. I'm just curious, Kate, when you're talking to your clients, are companies still as open to remote work, or are they pulling back there?
I think we give a lot of talk to pulling back into the office, but we're not seeing it. And what we are seeing in our client base, and we work with some of the largest brands, global brands in the world, is that talent is still in the driver's seat and talent is willing to say no. And that talent is still a big issue in the C-suite. And I think we're still seeing that our clients are committed to hybrid. We are seeing a little bit more in the office, and I think people are craving more interaction, but it's not full-time, and it's certainly not the way we used to work pre-pandemic.
All right, we'll have to bookmark our conversation. Our thanks to Kate Duchesne, RGP CEO.
Thank you.
Have a good weekend. Got it. Coming up, concerns for Apple are not easing. China's contribution to Apple's total revenue just hit its lowest point in nearly 3 years. We've got analyst insight on what lies ahead for Apple on the other side of this break. Stay with us. Netflix is reportedly looking to get into the boxing ring. According to the Wall Street Journal, Netflix is considering venturing into live streaming boxing matches. Here with more analysis and insight on this report is our own Alexandra Canal. Ali, I am so excited to hear this story. I don't know if you know this, but I used to train a little bit at Gleason's back in the day.
Oh. I love it. I love it, Diane. I mean, yeah, just another play for Netflix to really expand its live sports coverage, but in a unique way, not the way that we're typically used to seeing. They are experimenting with more live events. We know that they are going to be having a live celebrity golf tournament in less than 2 weeks. And so this report comes at the perfect time. According to the Journal, Netflix has discussed streaming a match with YouTuber Jake Paul and boxers from Premier Boxing Champions. Now, this strategy is one that I've mentioned has worked so far for Netflix, really taking those athletes who have become stars within their own shows, within their own sport and docuseries, and then really utilizing that star power to help drive interest in these live events. The golf tournament does that by utilizing players and athletes from both Formula One, Drive to Survive, along with Full Swing. So it's very much a different strategy than what we've seen elsewhere in the streaming space, where tech giants like Amazon, Apple, Google, and then legacy media players like Warner Brothers Discovery and Disney have really fought to capture live sports rights, but Netflix has consistently reiterated that they're not really in the business of that because of the heavy cost associated with live sports content. Instead, they really want to just experiment a little bit more with live events and these sports-centric shows. And I think that allows Netflix to really dip their toe into the water when it comes to sports, really kind of assess and see the reaction from subscribers, from viewers, and then make more informed decisions from there. The Premier Boxing Champions is owned by Paramount, but the company has said that they are shutting down their Showtime sports division. So that's looking for a new home. Perhaps this is the perfect opportunity for Netflix to have that on the platform and then potentially host this live boxing match as well. So again, just a report, nothing confirmed, but I do know that this is something that Netflix is really weighing as they look to differentiate themselves within the streaming wars more moving forward.
Weighing. Oh, I like that. I don't know if that was an intentional or unintentional pun there.
No pun
we'll see
intended.
if Netflix comes out. Well, here's one that is intended. We'll see if it comes out as the heavyweight. Ali Canal, thank you so much.
Big tech losing some of its shine this earnings season. The latest example is Apple, tech giant, reporting its fourth quarter sales decline, and the stock is missing out on today's rally on Wall Street. Joining me now is Ray Wang, Constellation Research Principal Analyst, founder. Ray, thank you so much for joining us. I want to first, Ray, just get your take on Apple. Obviously, Ray, some investors are disappointed by that guidance for the December quarter, the holiday quarter. Others on the street, Ray, I did see make the case today that, listen, given all the macro concerns and challenges, they thought it was actually an impressive performance for Tim Cook's company. What was your take? What did you make of that print? Hey, Ray, I think you might be muted, Ray.
So despite, so great question.
Now we got you.
When you think about what's going on, despite continued revenues decline for a year, Apple is a digital giant flight to safety stock in bad times, and it's a growth stock in good times. So sales are down, but iPhone sales are at a record high. The problem is Mac, wearables, all the other devices. And that's what people are worried about. But services outshined everything else. And so people are saying, okay, fine, we can stick with this as a safety stock. We're not sure when it's going to be a growth stock. And that's what people are waiting for to hear about in the December quarter guidance. And so that's kind of where the issue was.
And Ray, let me ask, because I was talking to Gene Munster over at Deepwater Asset Management. You know Munster, longtime Apple analyst, and we were chatting, and he continues to be an Apple bull. He is convinced that this company is going to return to growth next year. He sees better times ahead, Ray, specifically for that iPhone franchise, because Munster's point is pent-up demand, easier comps. I'm interested to get your response to that thesis.
Oh, I agree on the thesis. And it's not just the iPhone. You got a revamped Mac line with an M3 chip. Their operating margins are a lot higher than everybody else. Having the vertically integrated approach is going to help them. On the iPhone side, the services piece, if you think about it, it's not just hardware sales. It's the attach on the accessories. It's the attach on a cross-sell. And of course, it's what additional services you pick up. And the average revenue per user continues to go up. Now, there's an elongation of phone replacement cycles and Mac replacement cycles because everyone bought what they wanted in the middle of the pandemic. And so those are going to stretch out a little bit. And then, of course, there's the China factor.
And Ray, I want to switch gears here a bit. Let's talk about those hyperscalers too, those big cloud computing giants. Ray, we heard from Amazon and Microsoft and Google. What did you hear from their earnings reports, Ray? What did you learn about the ongoing cloud wars?
So the cloud wars are real. The three big players are at it, and Microsoft wants to be number two, and they've got the sales team to do it. But the challenge is they have the most antiquated cloud data centers. They use more power. They don't have enough capacity. The code is inefficient, but their head of revenue, Judson Aldove, is executing on all sales. Google has the best tech, the future TPU chips, the great engineers that are there, but the challenge is they've got sales execution that they got to deliver. And Amazon is still the leader in that war. Even though they're going to show slower growth, they've got an AI story they're about to tell when we get to AWS reInvent early in November, December.
And Ray, another big theme this earnings season was AI, artificial intelligence. There's a lot of companies, they're plowing a lot of time, money, and effort into that technology. I'm interested, Ray, among the big tech players, are there certain companies that you think are actually better positioned than others to monetize that technology across their portfolio of products and services?
Yeah, it's been said a lot by the dip because Google actually is in the best place for that because they've got the chips, they've got the engineers, and this little war that got started by Microsoft has got them kicked into gear, and they're in a really good place for that. So, and then of course, if you're buying the tools makers, that's going to be on the NVIDIA side because they're the ones providing those chips, but a chip war is about to break out on GPUs, and that's going to happen in the next 4 quarters.
And Ray, another question, and Diane actually raised it earlier in the show. When we talk about AI, where is Apple in that conversation, in your opinion?
So Apple's actually very interesting in AI. The AI just happens in the background. It's experiential. Suggestion happens. Your photos look better, right? The things that you're trying to do on a Mac on design just happen in the back end. Energy management just occurs. So they're doing AI. They're not talking about AI like everyone else because they don't see themselves as an AI stock because they realize that they don't need that to propel. So you see a lot of that built in. And from chip, if you look at the M3, the amount of AI that's being built into the chip, it's actually where it should be because we're going to see a growth in what we call AI computers that are actually at the edge. AI computing is going to happen because most of the data is happening in the edge yet. They're not all in the cloud. So they've got the right strategy by getting it right at the chip level and then going up the entire stack all the way up to the apps.
And Ray, we got NVIDIA coming up now, spinning ahead. They're going to report later this month. What are your expectations for that earnings print?
Oh, I think they're still doing really well. People can't get enough GPUs. The wait times are 8 to 9 weeks out. And we're actually, despite the export control headwinds, there's tailwinds behind the demand just for AI. And that's for the next 4 quarters. But we're also going to see some competition because AMD, Google, Microsoft, Amazon are all building their own chips. And we're going to see chip diversity as an issue. I was just at the Dell Tech Summit last week. And you could see what companies like Dell were doing with trying to get the right chips for the right workloads, for the right storage conditions, and that's going to be a big piece. And NVIDIA is one of their big partners.
And Ray, you mentioned the U.S. export controls there, and having an effect on different businesses. When you think about China, Ray, as an end market, listen, it's not just NVIDIA. There are any number of big American tech companies that look to China as an important end market. But given these geopolitical tensions, Ray, between Washington and Beijing, they are running hot. They're only getting hotter. How do you think American companies should think about the opportunity in China long term? Is it still big and healthy and vibrant, or do you think it's going to get smaller and more narrow?
I agree that it's going to get smaller and more narrow. Every CEO that's in an American company that believes China, if I can only get 1% of $1 billion market, which was the old pitch, that is out the door because we are at war. And it might not be an outright war, but we are at war, and you need to understand there'll be consequences of your investments in China. There'll be consequences if you're exposed to China, and there'll be consequences in terms of how you react to China.
Ray Wang, thank you so much for joining us today, Ray, for that insight. That was great. Appreciate it.
Happy Friday.
You too. And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned for more on Yahoo Finance.
That's the closing bell on Wall Street, wrapping up a risk-on day, risk-on really for this week. Wall Street putting a pin in what looks like the best week for equities for the year, for 2023. You're looking at the Dow finishing the day better by 222 points, set of triple twos there. The S&P 500 finishing up about 40 points, just shy of 1% there. Nasdaq finishing up, the star of the show, up more than 1% on the day. So investors really just putting their bets that the Fed may be done. Let's take a look at some of the trending tickers that we are watching. Shares of Expedia rallying double digits on the day, up 18% about for today's session. The online travel agency beating Wall Street expectations. Expedia announcing a $5 billion stock buyback program. The company posted revenue of more than $3.9 billion. That was up 9% from a year ago, ahead of street estimates. Profits up 33% from a year ago, so it certainly performed well. Oppenheimer saying that Expedia is arguably the best bargain in travel.
Yeah.
So
Look at that move.
Yes.
Nearly 20%. So it was a Q3 earnings beat, the capital return news you mentioned. Just looking at the different analyst notes, B. Riley says it was a strong quarter. Growth and margin drivers for 2024 are on track, they say. They got a buy on that name. I will say not everyone loved the results. Evercore's Mark Mahaney, we know Mark, well-known, well-respected analyst, says the results were mixed. Bookings and room nights growth were modestly below consensus. He has the equivalent of a hold, but a lot of investors have a buy instead today.
Yeah, indeed. I mean, some of the call-outs that I saw with regard to notes is that nights booked up 9% year over year in the quarter versus the second quarter. Lodging up 8% versus the second quarter where that was 7%. So you're seeing just strength there in terms of where the consumer stands, right?
Yep.
You know, so it points to that consumers are still spending on experiences, and Expedia is representing the case of strength there, especially when you compare that to, say, Booking, which, you know, wasn't received as well as Expedia was.
Yep. All right, moving on. Shares of QSR closed lower in today's trade. Restaurant brands taking a hit after reporting disappointed same-store sales from Burger King. Burger chain has been trying to make a comeback in the U.S. after lagging its rivals for years. Popeyes was the only brand that beat third quarter sales estimates. I love both, by the way.
Well,
I mean, really? No?
Well,
What are you
Popeyes,
down on?
yes.
All right, what?
Burger King?
Really? You don't like
Come on.
Who doesn't like a Whopper? Honestly.
Josh.
Grew up on Whoppers. Grew up on Whoppers.
Okay.
You can say a lot, Diane, but I'm not going to sit here and say you badmouth Whoppers.
Fine, you can have your Whopper. I'll take the chicken sandwich at Popeyes, which, as we know, that did really
What if you
well
want? I like both. Can't you just say both? Can
No, I'm sorry. We'll agree to disagree on that. But look, I mean, they missed estimates on sales. They had that weakness there for Burger King. As you mentioned, Popeyes, the standout there. Another thing they're getting punished for is just their talk about increasing advertising. And just this kind of turnaround plan that they're trying to push. But the problem with that is the cost tied to that. Now, you talked about, you know, so Wall Street may be a little down on it today. I mean, it didn't finish sharply lower, but it finished lower. TD Cowen says it does increase their expectations for sales for Burger King, expecting them to see comps at 5% versus 4%. TD Cowen says it remains encouraged about the key brand's underlying performance. So clearly it likes Burger King and maybe the Whopper as well, Josh.
Yeah, let's get a few more
and
fans.
they see the expense guidance as just noise, really just setting them up for a stronger 2024. So it'll be interesting to watch what actually happens.
So it looks like some Popeyes beats. Tim Hortons beats. I've never been to Tim Hortons. I don't have I have no line of sight into Tim Hortons.
But Canadians love Tim Hortons.
The Burger King, though, so their Burger King comparable sales for Q3, that missed, right? So what is the problem with the Burger King? The team at Cowen did tell their clients the issue is not idiosyncratic. There was a market slowdown, they said, at names like McDonald's, too.
Yep.
And they said their checks indicate traffic turned positive in September, so they're optimistic about Q4 traffic prospects. Outperformed, so the equivalent of a buy there, target of 77.
Yeah, another sector we're watching, this is within housing. Shares of Redfin closing down, let me say it that last. Actually, sorry, that was a miss on my part. Up more than 21%. Despite missing sales estimate for the quarter, Redfin making progress toward revenue growth again. The stock also moved to the upside after CEO Glenn Kelman seemed rather optimistic, despite that jury ruling earlier this week that realtors conspired to keep commissions for a home sale high. There's really just been a spotlight on that sector because of that ruling. I know you've been talking about that this week, Josh. And I mean, Kelman just indicating that they are positioned well if there is a shift in the industry in terms of how payments happen.
He says this is an outcome that Redfin is long prepared for.
Mm-hmm. Yeah. Right. So, I mean, so they're ready for this upheaval, I guess. Oppenheimer put out a note on Redfin. They say, this just tests the brokerage model. Like, are we going to see change to that model? But Redfin seems to be considering just a pivot with regard to that. So they were already, I guess, preparing for something like this. But the caveat that Oppenheimer giving, saying we need to see evidence of agent support before becoming more bullish on the long-term opportunity. So in other words, though there may be a change coming in terms of how the industry operates as a result of this jury ruling, is everyone on board with this, right? You know?
Yeah. I mean, I think one is the headline that CEO Glenn Kelman, friend of Yahoo Finance, we love Glenn, he's kind of sounding this optimistic tone on that jury ruling.
Yep.
That was one issue. And as for the results, if you look at the analyst commentary, some were kind of downbeat on it. They saw the results as kind of disappointing because they thought what they saw is kind of mixed underlying trends. They saw profit expectations they think continue to get pushed out because the housing market conditions have made that goal, they think, just more difficult. Others, though, said yes, they were mixed, which they acknowledged, but it was better headline print than maybe some just feared they thought was coming, and that gave some optimism.
Yeah, and then, I mean, one thing that bodes well for Redfin, website visits were up marginally, relatively speaking, up 1% year over year. So that is a positive. That's on the plus side when you think about the company's business and the challenges that we've seen within housing.
Right. By the way, this stock is up nearly 50% this year now.
Doing
nice
well.
move.
Yes, indeed.
All right. Moving on. When President Biden flew to Michigan in late September to cheer on striking auto workers, political analysts declared it a historic and risky maneuver. Critics blasted him for picking sides while he claimed to be the most pro-union president ever. Now it seems politically the move has paid off. Yahoo Finance's Rick Newman has more.
Hey guys, that is one of the first things I thought of when I heard about the UAW settlement. We don't have final ratification yet, but it looks like there is a deal and the workers are going to go back to work without too much real damage to the economy. I thought about Biden making that trip up there. You know, he went to a picket line. He was only on the picket line itself for about 15 minutes, but I think that was a pretty good investment of 15 minutes because Biden, you know, he picked sides in a way, and he picked the winning side here. And there were undoubtedly political calculations to him thinking maybe I should go to Michigan. Michigan and maybe even more importantly, Wisconsin right next door, both likely swing states in 2024. Swing states means that if you could just get a fraction of the vote, could be 1% or less, to side one way or the other, that could tip the election. So Biden can now say, hey, I stood side by side with the union workers. Union workers are going to see bigger paychecks in 2024. That is going to be good for him. And meanwhile, what did President Trump do around the same time? He went up to Michigan. He did not address union workers. He gave a speech at a non-union auto factory. And he said a bunch of really weird stuff, such as he had been trashing the UAW boss, saying he's not doing a good job. He said, all your jobs are going to disappear. The jobs are all going to go to China. And he described electric vehicles as a transition to hell. Well, guess what? Electric vehicles now seem to be included in some of the forthcoming union contracts. So Biden played this one pretty well. And I think we need to watch for developments in unionization in 2024. The UAW President Sean Fain says he's going to target non-union automakers, including Tesla, see if he can get some of those unionized. And this is happening at a time when Americans actually are pretty well disposed toward unions. They like the fact that workers are getting a little bit more power. So this seems to be one trend that might work in Biden's favor going into 2024.
So, yeah, Rick, you and I have talked about this before. There does seem to be this kind of labor uprising that we've seen across a variety of industries. What should we be paying attention to next on the union front?
Well, Biden needs to be able to claim success. I mean, he says himself, he describes himself as the most pro-union president in American history, and he needs to be able to say that that actually counts for something. And I think with this victory and other unionization efforts, he will be able to say that. That doesn't mean problem solved, though. Biden is underwater in terms of his overall approval rating, and he gets even lower approval for his handling of the economy. So he really needs to get that up if he really wants to have a good shot at re-election next year. But again, I want to go back to Biden's re-election odds don't depend so much on what the national attitude is toward his handling of the economy. It depends on the attitude of swing voters in swing states, and there are only 4 or 5, maybe 6 of them. And Michigan is one, Wisconsin is one, Pennsylvania, some think could be another swing state. And if people in those states think Biden's really going to bat for workers, and they are seeing that their own paychecks maybe are starting to get a little bit ahead of inflation, that would be good news for Biden. But we got to see it happen first. For the moment, Americans are pretty dour on the economy.
Rick Newman, thank you so much for joining us today, Rick. Have a great weekend.
You too, guys. See ya.
And coming up, housing hurdles, mortgages continue to hover under 8%. So where does that leave prospective home buyers? We'll discuss with our housing panelists. That's coming up next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Mortgage rates pausing a multi-week climb, but continuing to hover near 8%. Now, it comes after the Case-Shiller report showed home prices hit a record high in August, adding on to the fact major changes may be coming to the real estate market following Tuesday's historic verdict against the National Association of Realtors and large residential brokerages. So where does this leave prospective home buyers? Here to discuss, we have Kathy Casey, Caldwell Banker residential brokerage realtor, along with Lance Lambert, Residential Club co-founder and CEO. Thank you both for joining us this afternoon. Kathy, I want to start with you. Where does this leave home buyers right now from your perspective? Potential home buyers.
So, it is definitely a different market for home buyers than we've seen in the past. But, all is not lost. There's still hope. Buyers can still get in with some creative financing to get in under that 8% mark. You just really need to do your research, talk to a professional, take advantage of seller credits and builder credits that are going on right now. And there's some other creative ways that we can actually get buyers in for less than that 8%.
And Kathy, when you say creative financing, what do you mean by that? What are some examples for people to consider?
Some of the things that you can do, for example, I mentioned that sellers are giving credits to help buyers buy down their rate. So instead of an 8% rate, we might be able to buy that down 2 whole points to maybe a 6% rate. Okay, so that's something that we can do. Another thing that buyers that's starting to become popular now is looking into some assumable loans for buyers. FHA loans typically are assumable as long as you qualify for them. Same for VA and USDA loans. So if you have a seller that has a 2 or 3% interest rate, you might be able to assume that loan. You have to, make up the difference in what their loan balance is and what the equity is, but that could be a very viable option for a lot of buyers.
Lance, when you think about that verdict that happened this week, that was found that the National Association of Realtors and these large brokerages conspired to keep costs high, artificially high. What does that do? How does that change the landscape of the housing market from your point of view?
Yeah, right now it's a tremendous amount of uncertainty for the industry. Nobody exactly knows how this is going to play out. I call it something of an earthquake, and it's either, is it a small quake or is it the first tremor in something much, much bigger? But as of today, as of November 2023, I don't think it has a huge impact on buyers and sellers right now. But I think what is impacting buyers and sellers today is the fact that affordability has deteriorated to historic levels. When accounting for incomes, mortgage rates, and prices, last month was the most expensive of this century since 2000. And, this month looks like it'll be the second most expensive now that rates have come down a little bit under 8. But back to what Kathy said, there's things that buyers can do in this market. And one of the things that's becoming more attractive is the assumable loans. This morning I was talking to the CEO of Rome, and they are a company that is a listing website, and they've done the data to get the mortgage information to find out what homes available for sale right now have assumable loans, meaning they're FHA, USDA, or VA. And so if you go on their website, you can search and see the homes for sale today that could potentially be an assumable loan.
And Lance, so there are some smart, as you're pointing out, tips and tricks that prospective home buyers can think about, but you have these very powerful forces, Lance, which you've talked a lot about. Limited inventory and affordability has been crushed. How do we move past that?
Yeah, right now the market is kind of constrained. So the tailwind for the market is the fact that on a national level, there's just not much resale supply coming onto the market. There's not much inventory. There's not much churn, people who are selling their home to go buy something new, because if they did, they would be trading in that lower monthly payment for something much, much higher. And the fact that the competitiveness coming out of COVID just kind of drew down the inventory. So resale is the tailwind, but the headwind is this affordability that's deteriorated. The fact that mortgage rates have gone up and touched that 8% threshold, given how much prices have went up since the start of COVID. And so the two forces together are just kind of gridlocking this housing market and constraining the activity levels.
Kathy, I want to ask you a question. So Lance characterized what happened in terms of that ruling this week as an earthquake, potential earthquake, and it's just about the definition of what scale, what size is this?
Yeah.
How do you envision this impacting your business, this ruling that came down earlier this week?
You know, none of us really know. It's really a huge uncertainty in our market right now. It could be that buyer agencies will have a whole different look than what it does today. It could be a lot of different things. So it could be that lenders are going to maybe even pitch in and help with buyer agency. Maybe that's part of your buyer agency, your package when you get your loan, that, you know, we work that in. A lot of things could happen and go several different ways. It really is kind of an uncertain market right now in terms of that. So I'm anxious to see. No, I'm not. You know, I think that it is going to separate the wheat from the chaff. Definitely. I think that when the real estate market is good, a lot of people tend to get in that don't necessarily have the resources, or, you know, are just in for the quick buck and aren't in for the long term and aren't in for really providing good, reliable service for their clients. So I think it's definitely going to, you know, separate the diamonds from the cubic zirconiums. So I'm not concerned, though.
And Lance, let me go back to the housing market right now, these challenges. I'm just interested, any intel or data, Lance, that you have about who exactly is buying these homes right now? Who's out there buying homes? Do we have a sense of the demo?
Yeah, so the group that's really pulled back here is two. The move-up buyer, the person who kind of needs more space for family reasons and is going out and getting more space, that person is not transacting as much because they don't want to give up that lower mortgage rate. So affordability's kind of locked them in. And so the people still out there kind of buying and selling. On the selling side, it's kind of like the death, divorces, you know, what's constrained and what is always occurring. Whereas on the buying side, you know, it's kind of some of the first-time home buyers who kind of have no choice because rents have gone up so much. So some of them who can still make it work financially and haven't lost their mortgage eligibility are still out there. And then some of, you know, the wealthier retirees who just have the money and have the equity if they did sell can still go out and purchase something. And then some of these smaller, mom and pop landlords are still kind of out there trying to find deals that pencil. And some of the institutional big players that really play off of yields, and they're just not out there as much right now. So the institutional side is really constrained as well.
And Kathy, I want to ask you one more question just about where mortgage rates stand. And, you know, because we've had economists come on and talk to us about when you think about this from a historic perspective, it's actually not as high as it's ever been when you go back to the 80s, for instance. Do you think that there will come a point where, you know, the demand is unlocked, even though rates are as high as they are right now?
I truly believe that there's a lot of buyers that are standing on the sideline. Like Lance mentioned, right now, the majority of the transactions that are happening are necessity transactions, people that have to buy and sell because of life changes, divorces, you know, job changes, all of that. But there's a whole bunch of people that want to buy that are kind of waiting in the wings. And so I believe that there's going to become a point where they have what we call mortgage fatigue, where they're tired of waiting for the rates to go down and they just really want a house and they're going to figure out a way to make it work. And I believe that those, okay?
Mm-hmm. Go ahead, finish your thought.
I believe that that's going to happen soon. And when that happens, and they will have the advantage of when mortgage rates do go down, they can just refinance. Because once they do go down, I think that we are going to see somewhat of a market frenzy again.
All right. Well, Kathy, it's always great to hear from you. Kathy Casey and Lance Lambert, thank you both for joining us this afternoon. Have a great weekend.
Thank you both.
All right, you got it. From housing, shelter, to someone on the move, we have to chat about Amazon founder and former CEO Jeff Bezos, moving out of Seattle, apparently. He posted a video on social media of himself in Amazon's very first office in his dad's garage as he announced he will be moving to Miami. Part of the reasoning is that Blue Origin is planning on shifting operations gradually to Florida, and he wanted to be closer to his parents, apparently, Josh. So I guess Miami is going to be saying bienvenido a Miami. Sorry, I had to throw a little bit in there, you know. I mean, obviously, this also, I guess, puts him closer to Lauren Sanchez. You know, but one thing, the elephant in the room that we haven't talked about is taxes. We know that Florida is a very favorable tax state. So that is something that plays into its favor. It doesn't have state income or capital gains tax. And we know that there is a move coming from Washington state with regard to capital gains taxes.
Yeah, so he says he's moving because he wants to be closer to his parents. Seems reasonable. His partner, right? Of course, he also has rocket company Blue Origin. He's putting roots down, by the way. Bloomberg says he bought a mansion in South Florida for $79 million. And a few months after buying a neighboring one, by the way, Diane, for $68 million, which sounds like a lot.
Not to him.
Except that he's worth, right, an estimated $161 billion. So he's good.
Yes.
He's just fine. He can keep piling right on. I do think
change
yeah,
for
you
him.
you did bring up the tax though too. Fortune had a good piece on this, noting that a Washington State Supreme Court decision in March of this year upholding a 7% tax on capital gains that took effect in January 2022. So perhaps, you know, that is another reason, if you're Jeff Bezos, Florida, in addition to the family, the partner, the sun in the sand, that could be another reason.
Yeah, the
Florida,
sun in the sand
Florida
is
might
nice.
be looking good.
That part is nice.
It is
well,
nice.
the sand is nice. The sun sometimes gets a little
It's too hot for me.
there.
I can't do Miami.
It's
too much. No.
Yes, but vacation. I mean, it's a nice vacation. It kind of, Miami gives you that.
It's a nice place to visit, you're saying.
Yes.
Yeah.
I mean, I have a sister who lives there, so, you know.
He did say,
sometimes you go.
Seattle, you will always have a piece of my heart.
Well,
So
that's
Seattle,
nice.
you got that going for you, which is nice.
Heart, but not his taxes.
Yep. right.
All right. Coming up, one company is looking to use its funding to advance workforce management for the gig economy. I'll talk to Nick Lilios, now the CEO, that is on the other side of this break. Stay tuned.
2023 rocked the markets.
NVIDIA, the stock has been on a tear this
Silicon Valley
year.
Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Nasdaq announcing a $35 million Series C round of financing. The company aiming to help employers navigate an ever-changing workforce, I should say. Just today, the October jobs report showed signs of cooling in the labor market. Here to take a closer look into the state of the workforce, we have Nasdaq CEO Nick Lilios. Nick, thanks so much for joining us today. So talk to us first about this latest round of funding that you've received. Congratulations on this. What does this do for your scale plans?
Yeah, absolutely. So it lets us build out the next generation of technologies for frontline workforces. We're building an operating system for companies to be able to build, manage, and pay these frontline workers. But the reality is that the way that we work, especially in these industries and in these sectors, has radically changed, and employers are struggling to kind of keep pace. And so we're enabling a new form of work to happen that's oriented around flexibility for the worker. And so the funds that we've raised today are helping us expand our technology offering and really invest into AI and ML to automate the process and create a more seamless experience for both the managers on the ground using our systems and the workers who are working these jobs.
All right, Nick, we just got new data on the state of the job market today. Let's talk specifically about an industry that you have unique insight into, leisure and hospitality hiring. What kind of trends are you seeing based on the data that you have?
Yeah. So employers are struggling to recruit workers in these industries. Rates have increased, the available size of the workforce has decreased, and the preferences of the worker are changing. Workers are demanding more flexibility. They want autonomy and optionality in the way that they pick the work that they do. And they also want to be able to earn a living. They want better pay rates. They want access to more benefits. And employers are struggling to find ways to adapt to this. And so it's a really tough situation that employers are seeing. They're trying to find different solutions to accommodate these very different trends from what they're used to doing.
So you said that they want better pay rates, but there has been this kind of push-pull between employers and employees and who had and who has the upper hand right now. If they want better pay rates, are you seeing the responsiveness to that from the employer side currently, or is the trend changing from the data that you can see?
Yeah, so pay rates overall have increased pretty dramatically over the last 3 years. I think the inability for employers to recruit people, as well as the difficulty they've had retaining workers, has forced them to really invest into increasing kind of the pay for the workers. So overall, it's improved. I think employers are still struggling to kind of adapt to that. And so the ones who are not able to recruit are the ones who are not kind of increasing those pay rates. But eventually, most of them have realized they have to kind of improve what they're paying their workers if they want to see different results. And we're seeing that in the data.
And so you have some pretty big employers that utilize your company's services. I believe Marriott is one of those companies. I think Kroger has been one of those companies as well. What can you tell us about what you're seeing about the state of hiring within that sector, especially when you think about hourly workers? What trends are you seeing there?
Yeah, I mean, I think the primary one is being able to enable or provide a more flexible schedule. So giving the worker the choice to choose what shifts they pick up versus requiring that worker to work a traditional 40-hour work week. You often see employers historically being very strict around what those rules are, but you now see them even in job postings and advertisements saying, this is a flexible schedule. You can pick your hours. You don't have to work kind of that 40 hours. You also see them giving benefits. The question is whether these benefits are meaningful to the worker, but you see them sometimes giving lunches. You see them giving access to new types of tools, expanded access to healthcare for employees that normally wouldn't receive healthcare. They're investing or exploring all of these different types of options that normally are reserved for full-time employees or salaried employees. You see them now deploying those types of benefits increasingly often to frontline workers.
And Nick, what are you seeing in terms of the holidays and holiday hiring?
Yeah. So hiring is definitely increasing with the holidays, especially in the warehousing sectors, retail, things like that, as well as in hotels. I think what you're also seeing, though, is that they're increasingly having to turn to temporary labor sources to supplement kind of their existing workforce because they're still facing a lot of difficulties. That size of workforce has contracted, or the availability of workers in that workforce has contracted, and so they're trying to ramp up hiring, but they're often not doing that. And so I think they'll be investing more into it come the holiday season, but it remains to be seen how successful they'll be in achieving kind of the labor results that they need.
All right. Now still CEO Nick Lilios. Thank you so much for joining us this Friday.
Thank you. Great seeing you.
You got it. Great to be with you. All right, coming up, we're heading over to Texas, I should say, down to Texas, for JP Morgan Chase's Make Your Move Summit. Our very own Shauna Smith sat down with Ben Walter, JP Morgan Chase's business banking CEO, on the state of small business, economic outlook, and much more. That is next.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates,
a diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
We are at the Chase Make Your Move Summit in Frisco, Texas. It's putting a spotlight on small businesses. Now, we have thousands of small business owners gathered here, and they're talking about everything, sharing their success stories to growth plans, but also talking about some of the challenges that they face today and how they're navigating this murky economic environment. So here to talk about that and more, we want to bring in Ben Walter. He's the CEO of Chase for Business. Ben, it's great to have you here. Thanks so much for taking the time.
Thank you for having me. It's great to be here.
So you have a great pulse on the state of small business right now. I know you're partnered with just about 6 million small businesses here nationwide across the country. When we talk about the sentiment, what you're hearing from small businesses at the summit today, what is that like? What is their outlook?
Incredibly optimistic. I mean, that's the good news. When you ask, how's your business going? They say, really well. And I want to expand, and I need to expand. What they tell us is there's a few challenges. So the first remains inflation. So I'm happy to see that the Fed is continuing to fight inflation. I know they've paused for a while, but it's important that we get that under control. Small businesses really need that. They don't have the same buying power as big businesses, so seeing that really come under control is important for them. And the second challenge they're having still is hiring. It's hard for them to recruit enough people to grow and expand their business. They're telling us they want to borrow, they're telling us they want to expand, but they need to find the people to be able to do it, and that's a real challenge.
Ben, that's very similar from my takeaways so far with the business owners that I've been speaking with. They're very resilient, and also they're confident, though, just in terms of their growth plans and where they want to see their business be in a couple years from now. When we talk about looking ahead to 2024, are you confident that this trend is going to stick?
I am. I think we're in a little bit of a mood session. You watch the news every day and all you hear is bad news about how this might be going terribly, this might go down, we might see this, we might see that. But actually, when you look at the real numbers, the economy's good. Consumer balance sheets are strong, small business balance sheets remain in better condition than they were before COVID. So we see strength across the board. Hiring is strong, unemployment is very low. So the actual economic condition is better than the mood of the economic condition. And I think we need that to prevail a little bit. So I'm confident it's going to keep going because the fundamentals are good.
Ben, when we talk about what's happening right now in the macro environment, the Fed, whether or not they are going to raise rates again, my colleague Brian Zazi sat down with Jamie Dimon last night and asked him just about his sense and what he thinks should be done or needs to be done in order maybe to cool inflation. It was interesting. He said that the Fed was right to keep on hold yesterday, but when we talk about what it's necessary going forward, he said he wouldn't be surprised if we do see more rate hikes. My question to you is, what would that then mean for small business owners?
I think it's a false front, really. I wouldn't focus on rates and where they go. And the reason I always say that is, look, if the Fed is, everybody says, I hope the Fed starts cutting tomorrow. I really want the Fed to cut rates. Well, if the Fed cuts rates, it's because unemployment's going up, sales are going down, the economy's weakening. That's not a good place to be. So you don't necessarily want them to cut. You want them to fight inflation. You want them to maintain full employment to the degree that they can. And that's a good thing. So I wouldn't focus too much on whether the Fed goes up a quarter point, down a quarter point, holds another. I would focus on the economic fundamentals. And as long as those continue to be strong in the face of a slowing inflationary environment, that's a good thing. And businesses will continue to do just fine.
So it sounds like you think that there's still a possibility here where we could see a soft landing and avoid a recession.
It's definitely possible, but it's not a guarantee. So you might find, Jamie might be right, that the Fed has to hold rates or even raise again if it doesn't continue to decline. They might find that actually we have it under control and they can. But I wouldn't focus on what the Fed does, I would focus on what the economy does, because that's, when you talk to small businesses, they don't say, wow, I was up late last night waiting for the Fed decision. They say, I was up late last night worried about how I'm going to make payroll this month, worried about how I'm going to find that next sale, worried about how I'm going to expand into that new location and find credit. Those are the things they worry about.
Well, we know that small businesses, though, a lot of them are obviously so reliant on the consumer. When we talk about rising rates, I know you said not to focus on rising rates, but when you talk about the impact that maybe is having or could have here on mortgage rates, not too far from 8%. Jay Powell talked about just the impact that could have on the economy yesterday. Jamie Dimon also weighed in on that just in terms of what the outlook looks like here for housing, a bit cautious there. What is that then impact or the trickle-down effect that could have when you talk about maybe a slowing housing market, what that then means for small businesses?
Well, look, a slowing housing market people have to remember, this is part of what the Fed is trying to do. Yeah. The Fed is trying to slow the economy because it got overheated. So we can't have it both ways. You can't say, why is the Fed slowing the economy and why is the Fed doing exactly what it says it was going to do, right? So we need it to slow a little bit because if you want inflation to come under control, you need that excess demand to be, sucked out of the economy to some degree. To the degree that it pinches consumers' ability to spend and buy, there's no question that puts pressure on small business. But when we talk about those kinds of issues, there's also opportunities for small businesses. I've been saying for a long time, everybody wants to talk about the demand side of housing. What about the supply side? We need more housing. We've got a whole millennial generation that is in their prime buying years, and we're not building enough. And every time you build houses, those are business opportunities for small businesses. So we can't, we have to take both sides of that equation.
And Ben, that brings me to lending and what you're seeing here from small businesses. You talked about the fact that they're very optimistic. They're looking to expand. Those who are making investments, what are some of the trends that you're noticing at this point?
We see it depends on the industry. To your point earlier about housing, the industries that are closer to the consumer, think consumer retail, dining, restaurants, they are a bit more cautious because they are seeing pressure and the consumer is up against what they're able to spend. Where we really see strong investments is in business services still. Think technology, think consulting, think business services. We see huge investments in people, investments in buildings and infrastructure, and investments in equipment.
And when we talk about what it's going to look like here going forward, you mentioned some of the takeaways so far, the fact that business owners are very confident, they're very optimistic just about what the future holds. What is your message here as we enter what could be an unpredictable year when we talk about the election, the economy, and what exactly is going to play out here going forward?
Be prepared. Yeah. And be prepared for those outcomes, but build your business and execute your plan. You know, everybody wants to talk about what else is going on out there that I can't control. And I have no time for things I can't control. I only have time for things that I can control. And so my message to small business owners is, you know what you do control. Control that in the wake of this environment, and you'll be resilient and you'll come through. And we see that in our clients.
Well, one thing that they cannot control, though, is regulations. That was also one of my takeaways here from speaking with small business owners, just the fact that some of the regulations that are in place down in D.C., how that's really restraining some growth or some of the complications, some of the challenges facing these small business owners. I'm curious to get your perspective on how the Biden administration has affected. Has it made it harder? Has it made it maybe a bit easier in some aspects for small business owners today?
I actually think, so if I talk about the Biden administration, I think the place where I see things getting tougher is actually on people like us, which has a downstream effect. So if I look at, for example, the Basel III recommendations that have come through and what that means for capital for banks, I think my personal view is it's gone too far. I understand we need more to be compliant globally, but I think it's gone too far. That'll put upward pressure on the cost of capital. That's not good. When you talk about regulations for small businesses, there are the things at the federal level like OSHA, but it's really important that we talk about state and local regulation. And there we see a pretty widespread. And part of the reason you've seen outsized business growth in places like Texas and Florida is because they have streamlined those regulations. They have made them easier. And small businesses have to navigate a web of regulations from the federal level to the state to the local level, but there's way more at that state and local level. And so I would watch what's going on around the country in terms of competition between states and how they're streamlining the regulations to make it better for small business.
Ben Walter, we have to leave it there. Thanks so much for having us here at the summit. Really appreciate you taking the time. CEO of Chase for Business.
Thanks for having me.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
The diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. It is official. All three of the major indexes have logged their best week of 2023. Stocks rallying after the October jobs report came in shy of expectations. Investors are taking that as a signal the Fed could be done raising rates. The Nasdaq snapping a 3-week losing streak, including some of the biggest names in tech: Alphabet, Meta, Nvidia, Tesla. And the Russell 2000 actually had its best week since February of 2021. Stars is laying off 10% of its workforce. Reports say the cuts will be in the high double digits, but less than 100. Stars also announcing it is exiting operations in the UK and Australia. This coming ahead of the company's spin out from Lionsgate early next year. Lionsgate shares jumped more than 7% on the day. And don't forget, it is time to change your clocks. This weekend, daylight savings time is ending, and most Americans will be moving clocks back an hour overnight on Sunday. So that means you'll be getting an extra hour of sleep on Saturday night.
And here's a look at what to watch for next week. On Monday, investors will be keeping an eye out on Berkshire Hathaway earnings. Warren Buffett's company is set to report on Saturday morning. At least investors should have time to digest those results before trading starts Monday. There's also a bit of Fed speak. Governor Lisa Cook will be speaking at Duke University. Now on Tuesday, earnings start to pick up. We're going to hear from companies including Uber, Rivian, and homebuilder D.R. Horton. And on Wednesday, all eyes will be on Disney, the entertainment giant, reporting after the close. And analysts are looking to see the effects of cost cutting as Disney faces a renewed activist push from Trian's Nelson Peltz. Other companies reporting Wednesday: Warner Brothers Discovery, Under Armour, AMC, and Affirm. Fed Chair Jerome Powell will be speaking on Wednesday and Thursday as investors look for clues as to whether the Fed is done raising rates. And don't forget to tune in Tuesday. It's a big day here at Yahoo Finance. Our Invest Conference takes place all day, where you can hear from top CEOs and investors. Coverage starts at 8:30 a.m. Eastern. That'll do it for today's Yahoo Finance Live. Have a great weekend.
Yes, still tune in Monday as well.